What if I told you the so-called silver ban in Shanghai was never about banning silver at all? Look, the headlines scream, China cramps silver trading, or Shanghai shuts down retail investors. But here's what nobody's asking. Why would the world's largest manufacturing economy suddenly panic over a metal that most people associate with jewelry and old coins? I'm going to walk you through what actually happened, and I promise you, it's not the story you've been fed. So let's start with the number that should make you uncomfortable. 30-1. That's the ratio of paper silver contracts traded on the Shanghai Futures Exchange compared to the actual physical silver sitting in their warehouses. 30 paper claims for every 1 real ounce. Now, as you know anything about finance, alarm bells should be going off in your head right now, because that's not a market. That's a Ponzi scheme with extra steps. But we're getting ahead of ourselves. Let me rewind to 2024, because that's when things started to break. You've got to understand the psychology here. Chinese retail investors, millions of them, had just watched their life savings evaporate in the property sector. Evergrande collapsed. Country Garden imploded. The entire concrete equals wealth formula that defined Chinese middle-class investing for 3 decades just stopped working. So what do people do when their currency's wobbling and their primary asset class is worthless? They run to hard assets. Gold, obviously. But here's the twist. Gold is expensive. The average retail investor in Shenzhen or Chongqing can't drop $2,000 on a single ounce of gold. But silver at $25 an ounce, that's the poor man's gold, and they piled in. By early 2024, silver in Shanghai was trading at a 5 to 15% premium over London and New York prices. Let that sink in. The same metal, just sitting in different vaults, had completely different price tags. Why? Because China's market was cut off. They've got this 13% VAT on imports and a rebate system for exports that basically turned their domestic silver market into an island. Global supply couldn't flow in to cool things down. Now here's where it gets interesting, and this is the part the mainstream press won't touch. The Shanghai Futures Exchange didn't just wake up one morning and decide to crush retail traders. They were staring down a systemic collapse. I'm talking about brokerages going under. I'm talking about a liquidity trap that could have taken down chunks of China's financial infrastructure. Let me explain the mechanics, because this is critical. When you trade silver futures on leverage, let's say 10x leverage, which was totally normal before the crackdown, a 5% move in the silver price means you lose 50% of your account equity. Not 5%, 50%. And if silver moves another 5% the next day, you're wiped out. Your broker has to eat the loss if you can't cover it. Now imagine thousands of retail traders, all leveraged to the teeth, all moving in the same direction, and silver starts swinging 5% a day, which it did. Volatility hit 45% annualized by January 2026. That's crypto-level chaos in a commodity market. The Shanghai Futures Exchange had 2 choices. Let the cascade happen and watch brokerages collapse, or step in and kill the leverage. They chose option 2. May 2024. Margins go from 7% to 12%. Translation, you need more cash up front to hold the same position. By February 2026, margins are at 18%. That's a 50% cut in leverage across the board. They also started slapping position limits on retail accounts and flagging abnormal trading behaviors, which is regulatory speak for, we're watching you, and if you look like you're about to blow up, we're shutting you down. Now, I spent way too long digging through SHFE announcements, trying to figure out what abnormal trading actually means. And you know what I found? Vagueness. Intentional, strategic vagueness. They don't define the red line. They just tell you it exists. That's policy risk. Traders aren't exiting because of price. They're exiting because they don't know when the referee's going to blow the whistle. But here's the question nobody's asking. Who benefits from this? China produces the vast majority of the world's photovoltaic panels. And those panels need silver. Specifically, they need silver paste for the conductive layers. It's not optional. You can't make a solar panel without it. Now, if you're a Chinese solar manufacturer and your input costs are exploding because domestic speculators are bidding up silver, your margins disappear. And Beijing doesn't want that. Solar is strategic. It's part of their green energy export dominance. They're not going to let retail traders in Shanghai price them out of global competitiveness. So the intervention wasn't just about financial stability. It was about protecting industrial users. But, and this is a big but, there's a darker reading of all this. Some people think the ban is a price suppression scheme. The argument goes like this. If China really let silver trade freely, the price would explode, because the physical supply isn't there. All those paper contracts, they're fiction. And if everyone demanded delivery at once, the whole system would collapse and reveal that Western markets, especially COMEX in New York, have been artificially suppressing silver prices for decades. I'm not saying I buy that theory wholesale, but I will say this. The Shanghai-to-London premium is still sitting at $3.50 to $5 per ounce as of early 2026. Even after all the interventions, even after the margin hikes and the position limits. That premium is telling you something. It's telling you there's still a physical shortage in China, and the paper markets can't fix it. Now let's talk about the delivery bottleneck, because this is where things get spicy. Unlike COMEX, where most contracts are cash settled, meaning you never actually touch the metal, you just trade the paper, the Shanghai Gold Exchange and SHFE have a much higher rate of physical delivery. People actually want the silver. They want to hold it. And if you're an exchange and 10,000 contracts suddenly demand delivery, but you've only got 300 tons in your vaults, you've got a problem, a big one. SHFE silver stocks dropped to under 1,000 tons in mid-2025. That's near historic lows. And daily trading volume? At the peak, it occasionally exceeded the entire annual global mine production of silver. Let me repeat that. In a single day, Shanghai traded more silver on paper than the entire world digs out of the ground in a year. That's not a market. That's a casino. Do we really believe that's sustainable? Here's what I think is happening, and this is speculative, but stay with me. China's playing a longer game. They want a high silver price eventually. Why? Because they're the world's largest importer of silver ore. They're accumulating, but they can't let domestic speculators blow up the financial system in the process. So they cool it down. They let the air out of the balloon slowly. And while everyone's distracted by the ban narrative, state-backed entities are quietly positioning themselves for the next move. Some analysts call this the de-dollarization trade. The idea is that China wants to challenge the USD-denominated gold-to-silver ratio. They want hard assets on their balance sheet when the next global monetary shift happens. And silver, cheap, industrial, strategic, is the perfect play. But here's the catch. We don't actually know how much silver China has. The official exchange vaults are one thing, but private vaults, strategic reserves held by the PBOC or state-owned enterprises, that's all black box stuff. There are rumors, unconfirmed, that China's been secretly importing massive amounts of silver ore and refining it domestically, off the books. If that's true, the whole scarcity narrative collapses. And this is where I hit a wall in my research, because Chinese commodity data is opaque by design. You can look at customs numbers, but those don't tell the full story. You can look at exchange inventories, but those are a tiny fraction of total supply. The real number? Nobody outside Beijing knows it. Here's my read. The Shanghai premium doesn't go away. It might shrink a bit, but it stays, because the structural factors, the VAT system, the closed-loop market, the domestic demand, those don't change overnight. The leverage gets squeezed out, sure. Retail traders get pushed to the sidelines. But the industrial users keep buying. The solar manufacturers keep consuming. And the price? The price slowly grinds higher. But, and this is the uncomfortable part, if the West is right and China's sitting on hidden stockpiles, then the premium is a trap. It's a signal that lures in global arbitrage players who think they can exploit the gap, only to find out there's no real scarcity, just perception. I don't have the answer, and honestly, I don't think anyone does. Not the regulators, not the traders, maybe not even Beijing. What I do know is this. When an exchange resorts to vague language, sudden rule changes, and margin hikes that cut leverage in half, they're not operating from a position of strength. They're improvising. They're trying to prevent something they can't publicly admit is a risk. And that makes me wonder, what else are they not telling us? Because if a 30-to-1 paper-to-physical ratio can exist in the world's second largest economy without anyone sounding the alarm until it's almost too late, what other markets are running on the same fumes? Think about that for a second. The silver story isn't about silver. It's about leverage. It's about what happens when speculative markets decouple from physical reality. It's about regulators stepping in at the last second to stop a collapse and hoping nobody notices the duct tape holding everything together. And here's the kicker. This isn't a China problem. This is a global problem because the same dynamics, paper markets dwarfing physical supply, leverage masking real scarcity, regulators intervening when things get too hot, exist in London, in New York, in every major commodity exchange. Shanghai just got there first. So when you see headlines about a ban, ask yourself, what are they really banning? The metal? Or the truth about how fragile these systems actually are? I'll leave you with this. The Shanghai-to-London premium is still there. The margins are still elevated. The vagueness in policy is still intentional. And the solar manufacturers are still lobbying for lower prices, while retail investors are still looking for somewhere to park their money that isn't yuan or concrete. Something's got to give. The question is when, and who's going to be holding the bag when it does.